Hey, Ralph here, Zatara Transaction Advisors, zataratransactions.com. I just wanted to go over our light valuation. So this is our kind of shorter valuation. It's not we've got a second one, MVA standard and premium, that are like 168 pages, something like that. This is our like quick valuation, not quick, but our smaller valuation. Whenever we take a business to market, we'll do a valuation like this so that the owner has a pretty good idea of the risk and everything else and what the company's actually worth. So, yeah, at its core, measuring, matching risk and return. There you go. So, here's everything that's involved in a valuation, at least in our light one. Scott was the guy that created this. God bless you, Scott. Big fan of this valuation. I think it's the best in the market. So, first things first, you have your historical earnings. So, how much revenue the company did, uh, cost of sales, gross profit, operating expenses, operating income, SDE, and EBITDA. And then the normalized. So, this is reported. This is what the accountant showed after we ask a bunch of questions and stuff. This is the normalization. So, typically, owners will be pulling money out of their companies in various different ways. And so we have to figure out how much free cash is actually in the business, not what they're reporting for tax purposes, but what is actually coming out of the business, right? And then we have our projections, and then you have the reported balance sheet, and then the recast balance sheet for last year. We normally don't go back and recast back previous years. We'll just recast the last year, and then you'll have kind of a reason for your projections, right? So, okay, we're just going to expect a steady increase by 5%. Normally, projections, we split it up between you have your fixed costs, which are going to remain relatively constant, and then you have your variable costs, which are going to change with revenue, and they're going to stay relatively constant as a percentage of revenue. Okay, so then you have your most probable selling price. Here's the continuum, right? And then you have your multiple. Here's the industry multiple. Here's your multiple. Here's why. Your risk rating is over here. 52% is the risk score. So then we go over our different risk factors. So you have your marketability risk, right? So what are the seller's expectations? Are your expectations kind of within the norm? The revenue size of the business, the profit margin, the EBITDA size, the profit margin, seller's expectations. Whoops. I think they've doubled this up. It should only be just the one. They shouldn't have profit margin and seller's expectations twice. I think that's a bit of a whoopsie daisies in this one. But then you have your industry, geography, gross margin, and then SPOF. And then you have your operational risk. So then you have regulatory oversight, owner dependence, customer concentration, supplier dependence, key person dependency, financial controls and reporting, lease terms, legal and contracts, competition, facility, mission values, culture, ERP. And then you have your growth risk, right? So you've got financial trends, budget and forecasting, value proposition, differentiation, scalability, management and staff. This all has to deal with growth, right? Barriers to entry, customer satisfaction, location, sales and team, marketing team, systems, right? And then you have your capital risk. So how much working capital the business needs, your CapEx, latent CapEx. So how much you have to invest, how much has already been invested, capital structure, sales cycle, financial models, cash reserves, and inventory management. So do they have too much inventory, right? Are they really good at managing that inventory? Then you have your deal team risk. So are you willing to, how flexible are you on terms? How many decision makers are there? What training and transition plan are you willing to kind of offer? How financeable is the business, and how committed are you to the sale? And then benchmarking. So here we pull business value research data, right, on every industry whenever we're going to do a valuation. Not every industry, on the industry in particular that we're looking at. So, for example, this business here, there's 161 different businesses in this BVR that are similar to this business. And so they pulled all of the businesses that sold in this area to figure out, okay, what's the multiple? So you look at the mean and then the median, and here you go. You got your total price divided by net sales, total price divided by gross profit, total price divided by EBIT, total price divided by EBITDA, total price divided by SDE, total price divided by BIVEC, right? And so then, the median company in this is going to sell for around 36% of sales, 88% of gross profit, 4.8 times EBIT, 4.4 times EBITDA, 2.5 times seller's discretionary earnings, right? Vertical IQ data. So then you have your profit and loss. So this is the normal company. Here's the multiples that it typically sells for, right? And then the normal company here is the balance sheet. Here's what the normal company's balance sheet looks like. So whenever we're looking at the operational risk, you can start, there we go. So when we're looking at the marketability risk, you can start looking at, okay, how within the norm is this business? Same with the operational risk and the growth risk even, right? So how within the norm is this business? Is this a typical business? Does it perform better? Does it perform worse, right? And then, okay, so then we have all of our different methods. Right now there's 11 in this one. I don't know if we've added more to the MVA, but there's 11. So you've got all the different typical formulas we use for calculating the value of a business, right? So we'll start at the top. These are all asset approaches. Or cost approaches. There you go. So you got your book value, liquidation value, asset only, net assets plus SDE. So these are all the typical asset approaches or cost approaches. And then you have your income approaches. So you got your DCF method, owner operated method, financial method, strategic method. And then you have your market approaches, and these are just straight comps, right? So what is the business worth based on the comps? And then we do a weighting, and here's kind of what the mean and the median, and then the weighted averages. So here are all the methods, pretty comprehensive. The other thing to mention, I guess, is the weighting for the normalized profit and loss. We'll actually weight out each one of these years. So we'll try to remove the years that are way outside of what's normal, and we'll try to look at the trend. And that's kind of how we do our weighting. Typically, the most straightforward weighting would be 40% on the last year, 30% on the year prior, 20% on the year before that, and 10% on the year after that, or 10% on the projections, depending. And then cash close. So this is kind of interesting. So here are all the terms, right? You're going to have your working capital, asset retention, debt repayment, closing costs, repayment terms, and taxes. So all this stuff goes into figuring out what the owner is going to walk away with after everything's said and done. So cash close, you got your working capital. So the owner might be able to take however much working capital out, asset retention. So here are all the different things that the owner is going to keep. right? Working capital, he might have to leave stuff in the business too. So this could be negative, this could be positive. Debt repayment, so he's got all of his long-term debts that he's going to have to pay off. And then you got your closing costs, so okay, your legal, your accounting, your M&A advisor, and then your reps and warranty insurance. And then you're going to have your payment terms. So this is like an average kind of deal structure. So 70-30, 30 might be deferred, right? And then so here's what you get at the end, right? So you get this amount of cash. Okay, so total cash at close, or here's what you're going to have to pay for taxes, right? So here's, our tax rate chart. Here's the average, 20%, boom. Your taxes due at closing are going to be this. So then your cash at close is going to be all these things added up. This, and then with tax planning, here's what your accountant's going to be able to do if he sets everything up properly for you before you sell it, right? So hopefully he might be able to save you from paying Trudeau, $1.7 million in theory. And then we've got all of our recommendations for how to increase the value of the business. And then last pages are definitions. So it's pretty good valuation. This is just our short one. This is typically what we recommend whenever a guy is hot on just going to the market. He doesn't want to do the full valuation, so he doesn't want all the metrics. And if you got any questions, let me know. Raf@ZataraTransactions.com. Raf@ZataraTransactions.com. Raf out. God bless you.